So we are seeing a lot of M&A activity in real estate these days. Realty Income recently announced that it was buying Spirit Realty Capital. Healthpeak Properties announced that it's acquiring its or merging with its smaller rival, Physicians Realty Trust, and that kind of got us to thinking, what's next? Now we'll get into this in a second. And to be fair, we never suggest buying a stock just because you think it's an acquisition target. That's important to point out from the start. It doesn't always pan out. But there are some that look like better acquisitions targets than others. Before we get into it, take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. It's the best way to support this work Tyler and I are doing on YouTube, and you can get the top 10 stocks to buy right now. So let me start with kind of an interesting pairing that I think would make a good merger combination in the current market environment. So one that I don't think has a great chance of happening, but that I would love to see is Simon Property Group using some of its available liquidity to acquire Tanger factory outlet centers. Ticker symbol on those are SPG for Simon and SKT for Tanger. Um, so the reason is it would kind of create a dominant position in the outlet industry. Simon has its big fancy malls that, I think Tyler lives next to one that's overseas. I was in one in Las Vegas recently that has a valuation of something like $5 billion all by itself. It's the Forum shops that are attached to Caesar's Palace. That's a Simon Mall. But a lot of people don't also realize that Simon is the leader in the outlet industry. They have about a 2/3 market share through its premium outlets division. Anytime you see a property that says, X City Premium Outlets, that is a Simon property. Tanger is the only pure play in the market in the outlet space and has been performing very, very well lately. I'm pretty sure Tyler's a shareholder of them still as well. Um, Tanger's a really good business. But combined, they have about an 80 to 90% share of what I would call the high quality office or outlet industry. Now, the reason I say that I don't think the deal is necessarily that likely to happen isn't because of the ability to afford it. Simon has the cash and credit on its balance sheet to acquire like 7 Tangers right now. They have something like $9 billion of total liquidity. And Tanger is not a very big company. So the reason I say it's unlikely to happen is that it would create a near monopoly in the high quality outlet space and would be tough to get past regulators. Now, there are ways that it could happen. You could argue, for example, that it's necessary to keep up with e-commerce to have that kind of combination of brick and mortar outlet malls, or there are kind of lower quality outlet malls that if you look at the entire outlet industry, it's not quite as big of a market share. But I don't see it as totally likely, but it's a combination I would love to see. I think Tyler is about to talk about one that is a little more likely to actually transpire.
Well, I mean, I think this is a deal that's going to happen because uh, so this is a company. It's called Equity Commonwealth. It's a REIT, uh, but it's actually just a pile of cash masquerading as a REIT. Equity Commonwealth was a company that was mostly offices, but starting in about 2016, 2017, it basically started saying we want to unload as much office as we can and go and move into industrial real estate. But they haven't actually made a move yet. They tried to make an acquisition, but somebody else came over the top with a better deal. I believe it was Monmouth Real Estate. It was an industrial REIT, probably 2019, 2020. I can't remember the specific date. But this has been a company that's just been waiting, just been sitting on a pitch, waiting for it to happen. And as of right now, this is a $2 billion market cap company with $2.1 billion of cash just sitting on the books and is basically long-term debt free. So you're basically buying $2.1 billion worth of cash for a $2.0 billion market cap. You're buying 90 cents on the dollar for what they have here. And, in an interest rate environment like this today, they make $100 million a year on just interest rate or on their cash, so they can sit and wait on a pitch. And this is a company, for those who are familiar, this was one of Sam Zell's REITs. Sam Zell was we'll call him legendary, I guess is the term that we want to use, real estate investor for a long time, and was very well known for, you know, buying distressed real estate when everyone else was kind of eschewing the sector. And I think that DNA is very much imprinted in what Equity Commonwealth and some of its other ones, Equity Residential, for example, does. And so I can very much see a scenario in the next year or two where a couple industrial REITs that have grown a lot, but maybe took on a little too much leverage, probably aren't investment grade companies right now, will have to like refinance their debt and things will look a little shaky. I could definitely see somebody like that being an acquisition target of Equity Commonwealth in the next year or two. And for those investors who in Equity Commonwealth right now, they're making special distributions, kind of paying down a little bit of that cash to keep investors to stick around for a while. And as long as that cash pile is there and the people who are running this business are doing what they're doing, I think there's an opportunity for investors to just kind of like sit there and wait and be very patient with Equity Commonwealth, because they're good at what they do, and they're one of the management teams I would trust to make a good decision in this regard.
Yeah, so another one that I think has a better chance of happening than my first one is, and you can weigh in on this one because I know you know these companies pretty well, is Vici Properties, which is a massive REIT that owns primarily casino properties, but is actively trying to branch out from that into other experiential real estate types. They recently acquired a portfolio of those high-end bowling alleys that uh, my kids love going to, and I like taking them to. Um, I think they should acquire EPR Properties, a REIT that I talk about pretty often. Again, I don't own EPR because I think it's a takeover target, but it definitely would make sense. Um, a lot of your reservations with EPR in the past, Tyler, have been its ability to be able to grow in an accretive way, given the current state of its business. And I think under the umbrella of a very financially stable and highly liquid, a lot of liquidity, REIT like Vici would make a lot of sense. EPR owns experiential properties. It does own movie theaters, which in an acquisition that would probably end up being the focus of getting rid of. But it does own, water parks. It owns a gaming property, so that would fit into Vici's naturally. It owns ski resorts. Vail Resorts is a major tenant of EPR. Top Golf is a big tenant of EPR. Those are natural fits for what Vici is trying to branch out in, and it could kind of kickstart its growth strategy outside of its gaming core real estate without having to take on high interest debt because it could simply absorb what EPR already has, kind of like in the Realty Income and Spirit transaction that we saw. So that's one that I think would make a whole lot of sense. It would be easy to get regulatory approval for because it's a bunch of areas of real estate that Vici does not have much presence in so far. And from a financial perspective, I think it would eliminate EPR's difficulties with growth. So I don't know. Do you think that has any chance of happening or would make sense, or if I'm just crazy?
I mean, this is just kind of, armchair CEOing what would make good deals, but it certainly would kind of solve EPR's problem of what like management says it wants to do and what its balance sheet says it should do. You know, EPR is definitely much more leveraged compared to Vici Properties, and with the weighted average like lease for Vici right now, they have a much better opportunity to refinance, and their cost of capital is going to be more favorable. And if they can add that whole experiential, I understand that you're just kind of, it's diversifying, but also diversifying into experiential, which is both somewhat macroeconomically sensitive. Like if we hit a recession, obviously, these are the kind of properties that are going to suffer. And so, and if there's any like part of that rent that is tied to the performance of the property, that could be, not as great. But I think it would solve EPR's problem a little bit more of freeing up some capital, freeing up some liquidity. I mean, I can't imagine that EPR's, maybe there's some merger of the management. I'm not 100% sure on how it would work, but I think for people who are investors in EPR that have been expecting growth, but it hasn't quite been there because, you kind of have to thread the needle of, well, we've got to grow, but we can't improve the properties too much because we can't take on too much debt. And, it's been some expensive stuff out there right now. So I think it, just us kind of like floating ideas, I think that would make sense. Whether or not that happens, who knows? Even these deals that we've just heard about recently kind of felt like they came out of nowhere. So uh, it's a fun idea, and maybe if we float it out into the ether, somebody in management will pick it up. But yeah, I could see that working.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.